I know you don't need to be reminded of this, but for viewers, obviously, and context is important. So that 120% upside that you saw for the central fund within ARC, of course, between 2020 and 2021, and now, of course, year to date, the flagship fund down about 60%. What are the lessons learned then from you and the team from that kind of drop that we've seen?
Yeah. So it started actually in February of 21. We started declining. Truly disruptive innovation started declining in February of 21, while the market soared to all-time highs in 21, and now the rest of the market is suffering as well. So vaccine, people going back to work, supply shock. The businesses had shut down, wondering if they would ever reopen their doors, right? They shut down. At the same time, governments around the world were stimulating aggressively. So we had a supply shock, especially because demand actually was so much stronger than anyone expected. And I would say lessons learned, could I have dreamed, a technology investor, that supply chain issues would have lasted more than 2 years? No, I never thought that for a second. I thought we would be over that in a year, and certainly couldn't have predicted Russia's invasion of Ukraine. So the question is this a 70s style inflation, which is how the markets are treating it right now, and why our strategy has been decimated, and most growth strategies have been hurt very hard. We don't think it is. I think the market's pricing is pricing innovation as though we have a bad inflation problem that's going to take interest rates up even higher. We don't think so. We think actually the greater risk and opportunity is deflation. I think we're going to start seeing deflation on a month-to-month basis. We're already seeing commodity prices come down. They've broken down, many of them. That's upstream, at the top of the pipeline. At the bottom of the pipeline, around the world, we're seeing a massive inventory overhang as we're heading into the holiday season. How will they clear that? Discounts. So I think cyclically, we're going to see deflation. We're already seeing it in the pipeline. Secularly, we will also see deflation. We spend all of our research time focused on disruptive innovation, technologically enabled disruptive innovation that is inherently deflationary. But that's good deflation, because as prices for electric vehicles continue to come down, we will see a continued boom in electric vehicles. It will hurt the internal combustion engine cars, but it will help the innovators. So I think we're going into a deflationary period, much like the late 19 teens. So 1918, World War I ended. Spanish flu also hit. So think about that. War, flu, very similar dynamic, right? And the other similar dynamic was 3 major innovation platforms that were going to transform the world: telephone, electricity, and automobile. They were all scaling exponentially and took us into the roaring 20s. So supply shocks took inflation back then to 15%, but within a year and a half, 2 years, that inflation started dropping, and it ended down. I'm sorry, the inflation was 20%. It ended down, deflation, 15%, roaring 20s. I'd like to think that's what we're going into now, and there's a high probability we are.
Okay, so that's the deflation call. So are you also making the call that growth has bottomed now, that this is the opportunity to get greater exposure to growth, that we are seeing the bottom now in terms of the sell-off for tech?
So it's interesting to watch our strategy as fears about Fed tightening and more Fed tightening continue. On many days when the market's down, our strategies are up. Now, that is what tends to happen. I'm not promising this is where we are. My compliance department would never let that happen. But in the later stages of a bear market, our strategy starts to outperform. Even it may just be that we're down less than the market. Some days we're up when the market's down. Why? Because during the later stages of a bear market, the new leadership shows up and starts performing. We're the new leadership. We always are. And many people think, oh, I've got myself covered with the NASDAQ 100. No, look deeply into those indices. We are the new NASDAQ. And most of our stocks are not in those indexes. We haven't owned the FANGs in our flagship for quite some time. That's not the new anymore. TikTok has come along and destroyed a lot of models. So yes, I think that we're seeing the early stages of a bottoming process. At the same time, many people are saying we're going into a recession. Now, we think we've been in a recession, and that the negative numbers will reassert themselves after this positive third quarter, mostly because of the inventory overhang, and we need to clear that out. I think many forecasters may say, oh, this is going to last forever, this recession through. We think it's just a major inventory correction, and then we'll be on our way again.
So a short-lived recession is what you're forecasting?
Sure. Well, we believe it started at the beginning of this year. So if it ends in the middle of next year or the third quarter, it's not so short-lived. It's only short-lived given that, that many people in a midterm election year don't agree that we're in recession now.
So the skeptics would say that what we saw in 2020 and the early stages of 2021 was valuations, of course, being pumped up by that excess liquidity that was in the system as a result of years of central bank interest rates at near negative levels and, of course, quantitative easing. And that was never about the fundamentals. But you would obviously push back on that.
Yes. Well, if that were true, then we should have been soaring for the entire existence of our firm. We started our funds in 2014. The number of risk-off, risk-on periods we went through during that period up to COVID was quite astonishing. That low interest rate, negative interest rate did not do what most people think. It just didn't. They're ascribing the massive increase that our strategy saw in 2020 to low interest negative. No, we're going to say no. Innovation solves problems. COVID-19 created massive problems. We needed to sequence the virus to understand how it worked. We needed to develop tests. We needed a vaccine. So no wonder that our genomic revolution strategy was the best performing strategy during that period. Innovation solves problems. We needed to digitalize everything we do. Work, play, healthcare, education, and that innovation helped. Now, what has happened since then, because many people think that burst, and from the low in COVID, April of 20 to February of 21, our flagship strategy was at 360%. Now, innovation solves problems, but by the end of all of that, we were saying, okay, keep some powder dry, because our minimum hurdle rate of return for any stock to get into the portfolio is a 15% at a compound annual rate for the next 5 years. We hit that in February of 21. Now with the massive downdraft we've seen, our rate of return expectations have never been higher. I've never seen them higher in my career. Cannot tell you what they are because compliance, of course, has a lot to say about that. But as you said, being down 75% plus from that February peak, when innovation is still solving problems, and we have so many more problems than even during COVID. We have the war, we had all the supply chain problems, and we have a recession, which is going to force most companies to say, how do I increase productivity? How do I cut costs? Technology is usually the answer. So I think we're coming into a moment, hopefully many moments, where innovation is solving problems and our revenue growth rates are going to surpass by far the revenue growth rates that the overall economy will deliver.
Would the Fed signaling an end of front-loading of hikes prove a catalyst, do you think?
Very interesting. I think you may know that we wrote an open letter to the Fed saying, wait a minute, how can the 12 of you unanimously agree on 75 basis points at, one right after the other when commodity prices are falling, inventory overhangs are crushing companies, and so you have upstream deflation. We believe downstream there will be deflation. There's no debate over this? Are you kidding? Do you know that in the early 80s, and I was fairly new to the business, Chairman Volcker was fighting a 15-year inflation problem. It started in 1964 with the Vietnam War and the Great Society. So 15 years, and people were used to inflation, so they were demanding it in wages and so forth. He took interest rates up twofold, 10% to 20%. This Fed has taken interest rates up roughly 16-fold in 9 months. Now, economics takes place at the margin, changes at the margin in all kinds of pricing, and interest rates are prices. Changes at the margin are incredibly impactful. And I think we will look back in history and say, wait a minute, a 16-fold increase in 9 months without stopping to see what's happening is crazy. It's crazy. And this is what will take inflation from up 8 to 10%, where we think it peaked, to negative.
You talked about cost cutting and companies trimming. We've seen from the likes of Meta, hiring freezes there, other big names, Amazon and others, putting in place hiring freezes or indeed cutting jobs completely. How much bloodletting do you expect to see across the tech sector? How much more pain in terms of job cuts and in terms of reining in budgets?
Well, if you look at trendline employment gains, I think we're 9% above the trend that was in place pre-COVID. In other words, a lot of companies, and tech companies included, hired many more people than they should have, given what was going to ultimately happen to demand. And you know, the first place you see a recession is in advertising, and the advertising budgets have been slashed. That's why, to me, hearing people say we're not in a recession and seeing advertising budgets cut in half by some companies is quite astonishing. And it's hitting the tech sector because so much of tech has become social media. But other technologies, I think, that help drive efficiencies, so more enterprise SaaS, they're probably going to do a lot better. You know, we receive a lot of criticism for holding Zoom. Many people say, that's a COVID stock. Well, Zoom basically gave its service away for free to consumers and to education, which was the right thing to do for a crisis period. Now they're all cycling out, and enterprises are cycling in. Enterprises, I believe, 55% of their revenues, and they're adding new features and functionality. This is the first rip and replace cycle in the enterprise communications space, which is the largest part of the tech stack. So it's $1.5 trillion a year. First rip and replace cycle since the early 90s. The early 90s, Cisco helped build the backbone of the internet. All of that was on-prem, hardware-centric. Now all of that is going into the cloud, and it was stimulated by COVID. These enterprises finally said, okay, we have a reason to make the change now. Two winners, Microsoft and Zoom.
What do you see in Robinhood? This is the mobile trading platform. You've been buying Robinhood in recent weeks. That is a company that's cutting jobs. That is a company that's retrenching. Yep. Some of their incumbent competitors, Charles Schwab amongst them, are doing very well. What do you see, though, in Robinhood?
Yes, so the Robinhood, along with Coinbase and Block, the three of them we think are in the running for dominating, potentially, the digital wallet space or becoming an important component of it. Robinhood is very user-friendly, and it is now moving into the crypto age, which is what it was missing. We've watched that very carefully. There is a company in Israel called Fireblocks, and we were very happy to learn that Robinhood basically ended its strategy of building internally its own crypto platform from an infrastructure point of view and hired Fireblocks. Robinhood's core competency is the user interface, the convenience, ease of use, and so forth. So it could become either the digital wallet, more likely it will become a part of a digital wallet ecosystem, either alone, standalone, or in partnership with someone, or as part of someone else.
Tesla, obviously a big part of the flagship fund. You must be concerned, Cathie, that Twitter and the takeover of Twitter to buy Elon Musk is a major distraction from the operations of Tesla.
Elon Musk is our Renaissance man, or our Thomas Edison, perhaps. And if you go back and look at how many projects these innovators were working on, you'd be astonished. How did they do that? There are such people out there. Elon surrounds himself with great business people and engineers who want to work for him. He is solving the most challenging problems of the day, and they want to be a part of that under his leadership. And, you know, remember, he started in the payments industry. So we could actually see Twitter, and now we just started a public-private crossover fund. Twitter is in that fund because we do believe that Twitter, Elon certainly believes in vertical integration. He has the payments experience. He and Jack Dorsey seem to get along very well, and were talking quite a bit, as we learned from the documents that came out over the court cases. And so I think even Twitter could make a run at digital wallet, not just for financial services, but for commerce. So that's one. And then you'll remember, I don't know if you remember, but do you remember Vine? Yes. My son, I thought he was going to make movies because he was on Vine constantly. That was a precursor to TikTok. And so there's some DNA within Twitter still, I believe, that could introduce something like that. You never know. And then one of my first experiences as an equity analyst was in newspapers. And believe it or not, they were the rising stars of that day. And this subscription advertising model is a very smart move if he goes in that direction. The verification, that little check, is very important to people and could help clean up the platform considerably. So
$8 for the blue tick is fair. To be clear, so you say public and private fund invested in Twitter. So you were putting in money as part of this deal?
Part of this deal, and what we're trying to do is, and I know this is an overused word, but democratize venture capital. What is the question our clients ask more often than any other? Why is it that we don't get a shot, given how innovation focused we are, this is the client speaking, a shot at some of these moonshots in the private space? And the answer is, you're not accredited. That's what the SEC says. Accredited means you have to meet certain income and asset thresholds. I think that's un-American, frankly, because if accreditation, just like with a driving license, if accreditation was about knowledge, our clients would be the accredited investors. So we said, okay, we will, using an interval fund structure, for a minimum of $500, you can participate in this public-private fund. Inflows every day, outflows once a quarter, up to 5% of net asset value. So we're fledgling. We've just started.
So how much has been invested in Twitter then, via that fund?
So I don't know what the final number was. I think it was around $1 million. Again, we're very, very small now. We're very small. Right. But over time, we would like Twitter to be a larger holding.
Okay, interesting. But I do really want to push you on this because he's the head of SpaceX, Tesla, the Boring Company, Twitter. There's got to be some impact in terms of the attention on the one of the core holdings in your flagship fund.
Portfolio, yes. So if you look at the electric vehicle part of the business, it is on automatic pilot. They have got the manufacturing team in place. Elon says that Tesla is a manufacturer of factories. And of course, with Optimus, the humanoid robot, and all of the other automation that he's bringing into the ecosystem, I do think it's more, these are manufacturing-oriented decision makers, and he's in there if there's any artificial intelligence, especially with the robot side of the business. Where we need him to focus is autonomous. We think he is very diligently. He believes that he'll have he will have an autonomous taxi network perhaps next year. We believe it'll be in 2024. But the heavy lifting even there has been done. The kinds of breakthroughs we've seen in artificial intelligence over the last just even 6 months, breakthroughs that we didn't expect for 10 years have happened in 6 months. And I think it's making autonomous driving that much more possible. Again, the people who want a very hard project in the AI space are working at Tesla. This is the hardest project out there right now. And I think they have the best and the brightest.
Before I let you go, Bitcoin, it's been bouncing around 19,000 to 22,000 since August. What is going on with Bitcoin? Relatively unvolatile asset at this period.
Compared to our other assets, right? It does appear that institutions are moving in. They're taking this price decline from nearly 70,000 to roughly 20,000 as an opportunity to move into a new asset class. And you know, in 2018, Cambridge Associates, which is a consultant for the institutional space, basically said to its clients, okay, you may not like this thing called Bitcoin. It may sound like a Ponzi scheme to you, but it's acting like a new asset class. And that got their antenna up, because what institutional investment managers cannot miss is a new asset class that will diversify the portfolio, meaning lower the correlation of the returns. And Bitcoin is doing that. And we think other crypto assets
And your
will
team's
as
holding
well.
on to the $1 million forecast?
Oh yes, more than $1 million.
Above $1 million?
Yes.
By 2030?
2030. And in order to see the building blocks, you'll see we're not making crazy assumptions. The building blocks are in Big Ideas 2022 at arc-invest.com.